Good day, fellow investors. We recently discussed how one should make more money from investing rather than from his job, and there were some very interesting topics and comments more on the philosophical side of investing, but I wanted to discuss it because I know you'll enjoy it. Let's first start with investing works. 64-year-olds and living proof that making more money from investing in life rather than working is the truth. However, there was this comment on uncertainty. When it comes to investing, investing should be defined as navigating uncertainty. I don't know the future, investing is about the future, and that is where a lot of people get blocked. So I am unsure what percentage of yearly growth return is realistic. For a self-taught casual investor reading some books and doing some homework, I shoot for 12+%, and if I miss by a little, it's still worth it, as we discussed in the video. There are 40 years, so even sustained compounding will do well. Now, when it comes to this 40 years in front, returns and something, I want to discuss the wrong perspective usually investors have. When it comes to investing long term, the key is that if you have a value investing mindset, yes, you will make your 8, 9, 10% per year here and okay. However, the key is that over 40 years, and that is why I always say don't look at the moment, look at the 40 years life investing cycle. In the 40 years, I can guarantee you, you will have more, but I can guarantee you 4 huge investing opportunities where your investments at the right time, making the right decision at the right moment in time, will lead to huge returns over the long term. Because if you have the right mindset, then that is the situation. I have done it many times over in the last 23 years investing, and therefore you cannot even compare the standard linear projections that there are with, I don't know, investing in stocks analysis with what the mindset brings you, not only in stocks, real estate, houses, investments, etc. It is a game changer, just the concept. But then there is the question, if the next decade is negative returns, how does it compound if there are technically no returns, just erosion? First and foremost, we have to focus on value, because we don't take lower returns than 10%. How can you get 10% if the market goes down? Well, first, a value investor doesn't invest in the market. We buy businesses that create value over time, that are fairly priced or even great prices, and then this discrepancy between long-term intrinsic value and the price, this is where you get your return. If the price is above the intrinsic value, as we usually discuss for the market and we'll discuss later, you don't invest there, you wait for other opportunities. On my research platform with the model portfolio, we have done better than the market over the last 7 years by focusing on totally different things. And my message is always, the P ratio of my portfolio now is 10, 12. The market's P ratio is 30. So I am getting a 9% earnings yield plus the growth, and no matter what happens with the market, this will likely be my long-term return. And then, of course, it's hard to know whether it will be 15 or 10%, but here we have invested, what was it, a month, and you get to 20,000 over 40 years. But even if lower, it is still good. And here again, one positive account that it works, and already 28, 6+ figures, 45% up or something like that, and just starting the compounding. However, there were also comments how I'm afraid I will not be there in 40 years. Not all of us have 40 years in front of us. And yes, it is better to start as early as possible to gain the knowledge. However, here we have another comment but a good comment. My father passed away at 69. His pension with a growth clause passed to my mother, who is now 91. I calculated that recently his earnings after his passing exceeded his income during his working life. Discussing this, I want to discuss the concept of investing. This is a house I bought in 2016. We paid, with refurbishing and everything, $300,000. We sold the house 3 years later for $450,000. So 50% return. We didn't put any money down because it was all a mortgage. So we created $150,000 out of nothing. Now the value is likely $700,000, and I was paying $1,300 for my mortgage, and the rent now likely surpasses $2,500. That's what I want to also share. It's not about time and long-term returns. It is about the concept of investing, to take advantage of the opportunities. And you can take advantage of the opportunities only if you have a trained mind. It's like, okay, he can run a marathon, but he is training his whole life to do that, and to constantly do that once a year. If you try to run a marathon now without training, you will get hurt, which is what usually happens to many out there when it comes to marathon running or investing. That is the key that I wanted to discuss, the concept. You never know where the opportunities are and how fast you can get those returns. Now, also a good question here is for your children, investing for the children. Here also Jack says, so what to do? Should I live frugally so my kids can have a party where I am gone? My opinion is that, in line with what Buffett is saying, you should give your children enough so that they can do anything, but not too much so that they don't have to do anything. And I'm looking a little bit also at inheritance and everything, and I think that if you give your kids anything, you deprive them of the most important situation in life, which is that they made it by themselves. If you take that away from them, you have destroyed their life. So invest in their education, invest in their grit, invest in this, invest in that, but don't tell them, oh, you get this, you'll get this, you'll get that. That destroys a human being. And I'm looking everywhere around. When there are kids that know that they will get something, it's gone, most of cases. So be very careful with that. Try to train them that they do it on themselves. Then they have the self-confidence, the pride, and when your money eventually, if it comes, they will know what to do with it. Not that they base their whole life on something that they will get for nothing. That's the key trick when it comes to inheritances. Again, another comment, don't listen to people always saying the market is overvalued. And also here, I'm tired of you saying on and on the same. However, if we look at the situation now, interest rates, higher likely inflation, the P ratio of the market, now the market is overvalued. And then again, in the long-term investing cycle, 40 years, maybe in 5-10 years the market will be fairly valued. Then I'll be saying, yes, the market is fairly valued, these are the better opportunities, this and that, or you just buy the market, you will do fine. But if you're buying the market now, which is the situation now, you're buying at the most expensive level in the history of financial markets. Good luck with that, I'll stick to value investing.